CPU stock price gaps. Stock price gaps occur when significant news, either positive or negative, is announced before the market opens, leading to substantial price movements. Investors anticipating a sharp rise or fall in stock prices will buy or sell stocks before the market opens, creating a gap. This means that the price will not open at the previous day's closing price, but will jump to a higher or lower level, leaving an empty area on the chart known as a gap. The principle behind gaps is based on supply and demand. For example, if many investors want to buy a particular stock, the increased purchase price creates a larger gap. Types of gaps. Number 1. Ordinary gaps. Ordinary gaps typically occur during periods of sideways movement and are formed after minor good or bad news. These gaps are usually filled shortly thereafter and do not significantly change the stock's price pattern or trend.
For instance, a successive share price formed an ordinary gap on June 80, 2021 when a U.S.
corporation bought the company's stock. The market viewed this as positive news, creating a common gap, which was filled the following week. 2. Breakaway gaps. Breakaway gaps occur when the price jumps out of a sideways market, signaling the start of a strong trend. This type of gap is the strongest and often marks the beginning of an uptrend. Identifying breakaway gaps can significantly improve the ability to buy stocks early in an uptrend. For example, ABNB's share price formed a breakaway gap on November 5, 2021, following an earnings announcement that exceeded expectations as COVID subsided. The stock price continued to rise, forming an upward trend. 3. Persistent gaps. Persistent gaps occur during the market's acceleration phase, often within an uptrend, and are rarely filled quickly. These gaps indicate strong market momentum and are usually not accompanied by dense trading patterns. For instance, in the case of LC, the first gap that broke through a sideways phase was a breakaway gap, while the second, appearing during the market's acceleration, was a persistent gap. The main difference between the two is that one occurs in a sideways market and the other in an uptrend. 4. Exhaustion gaps. Exhaustion gaps occur with fast, large stock price fluctuations during rapid rises or falls, signaling the potential end of a strong trend. They are characterized by sharp price movements and indicate that the current trend is losing momentum. For example, the SXI of the U.S. stock market formed an exhaustion gap at the end of an uptrend. As the name suggests, this gap indicates that the uptrend is ending, often leading to a reversal in the stock price trend. Jiaqu. Summary. Ordinary gaps typically occur during sideways movement, minor impact on trend. Breakaway gaps mark the beginning of a strong trend, significant for early trend identification. Persistent gaps indicate strong market momentum during an uptrend, rarely filled quickly. Exhaustion gaps signal the end of a strong trend, often lead to a trend reversal. Understanding these different types of gaps can help investors make more informed trading decisions based on market patterns and trends.